Mastering Accounting Basics. A comprehensive guide for beginners. In this video, we dive into the basics of accounting. While we will only be touching the surface, you should still get a good introduction to accounting. We will cover the essential principles and practices that form the backbone of accounting. Let's get into it. Accounting is the language of business, as we discussed in another video. It's the process of recording, classifying, summarizing and reporting financial transactions of an individual or organization. It provides a clear picture of financial health and performance, helping stakeholders make informed decisions. Whether you're running a small business, managing personal finances, or pursuing a career in finance, understanding accounting basics is crucial. Key accounting concepts. Here are some key accounting concepts. The first one is assets. Assets are resources owned by a company and have economic value. Examples include cash, inventory, equipment, buildings. Accounts receivable, which is money owed to the company by its customers. The next concept is liabilities. Liabilities are the company's financial obligations or debts. Examples include loans, accounts payable, which is money the company owes to suppliers. You can think of it as the opposite of accounts receivable. Taxes payable and wages payable. The third concept is equity. Equity represents the owner's stake in the company. It's calculated as assets liabilities. The fourth concept is revenue. Revenue is the income generated from business operations. Examples include revenue from selling products or providing a service. Interest income is another source of revenue. Revenue from selling goods or services is called operating revenue. Revenue from things like interest is called non-operating revenue. Operating revenue is revenue derived from a company's core operations, while non-operating revenue is derived from activities unrelated to a business core operations. Interest income, for example, is not considered operating income unless your business is running a bank or other financial institution whose core business is lending money to earn interest. If you're operating a restaurant, for example, and you earn interest from money deposited at the bank, that interest income is non-operating income, because a restaurant is not in the business of lending money. The last concept we will look at is expenses. Expenses are the costs incurred in generating revenue. Examples include rent, salaries, utilities, advertising costs. Those were some of the core concepts in accounting. Now, let's talk about the fundamental accounting equation. The foundation of accounting is the accounting equation. Assets equals liabilities plus equity. Let me repeat that. Assets equals liabilities plus equity. This is the foundation on which all accounting is built. This equation must always be in balance. If it is not in balance, you know that something is wrong with your accounting. Every transaction affects at least two parts of the accounting equation. For example, when you buy inventory with cash, assets change, cash decreases, inventory increases, but the total assets remain the same. When you take a loan, both assets, cash, and liabilities, loan, increase. In both examples, the equation balances. Double entry bookkeeping. Double entry bookkeeping is another core accounting principle. Double entry is a system used in accounting where every transaction affects at least two accounts. Each transaction has a debit entry, left side of the ledger, a credit entry, right side of the ledger. A ledger is a record of all financial transactions of a business. There are different types of accounting ledgers, which we will discuss in another video. The total debits must always equal the total credits, ensuring the accounting equation stays in balance and the ledgers are balanced. If the ledgers are not balanced, the financial statements will not be correct. Financial statements. And talking about financial statements, what exactly are they? Financial statements show a company's financial performance and business activities. Properly prepared financial statements will tell you where a company's money came from, where it went, and where it is currently. There are four main financial statements, not three as many people think. They are the balance sheet. This shows the company's assets, liabilities, and shareholders' equity at a specific point in time. Assets are listed on the left or top. Liabilities and equity are listed on the right or bottom. The total of assets must equal the total of liabilities and equity. The balance sheet is the financial statement that best demonstrates the accounting equation, as I mentioned earlier, is Assets equals liabilities plus equity. Income statement, profit and loss statement. This shows the company's financial performance over a period of time. It starts with revenue. Expenses are then subtracted. This leaves net income, net profit, or net loss. Cash flow statement. This shows how changes in balance sheet accounts and income affect cash. It's the amount of cash that flows into or out of a business over a specific period of time. It's divided into operating activities, investing activities, financing activities. Statement of changes in equity. The fourth financial statement is the statement of changes in equity. It is often lumped with the income statement, but is its own financial statement. This statement measures changes in shareholders' equity over a specific period. Types of accounting. There are two main types of accounting. Financial accounting. Financial accounting focuses on preparing financial statements for external users based on generally accepted accounting principles, GAAP, used in the U.S. or International Financial Reporting Standards, IFRS, used in most other countries. Managerial accounting. Managerial accounting provides internal stakeholders with financial information for decision-making, planning, and control purposes. Accounting principles. There are certain principles that govern accounting and make it all work. Accrual basis versus cash basis accounting. Accrual basis. Under accrual basis accounting, revenues and expenses are recorded when they are earned or incurred, regardless of when the actual cash is received or paid. If, for example, a company sells products on credit and won't receive payment until 30 days, it records the revenue when it makes the sale, although it has not yet received the cash. In this case, the company will pass an entry to debit receivables and credit sales for the amount it has sold. The receivables is an asset on the balance sheet that it will collect after the 30 days, while revenue will be reflected in the income statement. When cash is received after the 30 days, the company will debit its bank account for the cash and credit receivables, which will cancel out the debit balance that was recorded when the sales were made. Cash basis. Under cash basis accounting, revenues and expenses are recorded only when cash is received or paid. In the previous example, if cash basis was being used, no entries would be done when the sale was made. Entries would be done only when payment is made after the 30 days. The entry would be to debit bank and credit revenue. No receivables account is used in cash basis accounting. Matching principle. The matching principle says that expenses should be recognized in the same period as the revenues they help generate, ensuring accurate net income measurement. Consistency principle. The consistency principle says that accounting methods used should be consistent from one period to the next for comparability purposes. If different methods are used, the results would not be comparable over different periods. Materiality principle. The materiality principle says that you should only disclose information that would impact users' decisions. Whether a financial statement amount is material or not depends on its size and impact relative to the financial statements as a whole. Chart of accounts. The chart of accounts is an organized list of all accounts used by a company. Each account is assigned a unique number for easy identification and categorization. It typically includes asset accounts, 101,199. Liability accounts, 201,299. Equity accounts, 301,399. Revenue accounts, 401,499. Expense accounts, 501,599. Debits and credits. Another cornerstone of accounting is the use of debits and credits. Understanding debits and credits is crucial in double-entry bookkeeping. Debits and credits tell you whether an account will be increased or decreased for a particular entry. Accounts are increased or decreased for debits and credits as follows. For asset and expense accounts, debit increases the balance. Credit decreases the balance. For liability, equity, and revenue accounts, debit decreases the balance. Credit increases the balance. Remember, the total debits must always equal the total credits in any transaction. The accounting cycle. This is the process accountants follow to record transactions and create financial statements for a specific period of time. Steps in the accounting cycle may vary, but a typical cycle may be as follows. 1. Identify the transactions. 2. Record the transactions in a journal. 3. Post the transactions from the journal to the ledger. 4. Prepare an unadjusted trial balance. 5. Make adjusting entries. 6. Prepare an adjusted trial balance. 7. Prepare the financial statements. 8. Close the temporary accounts. Accounting principles and ethics. Accountants follow generally accepted accounting principles, GAAP, in the U.S. or International Financial Reporting Standards, IFRS, elsewhere. These standards provide guidelines for consistency in reporting, full disclosure of financial information, materiality, focusing on significant items, conservatism when making accounting estimates. Ethics in accounting is crucial. Accountants work in a position of trust and must maintain high ethical standards. Accountants must 1. Maintain integrity and objectivity. 2. Avoid conflicts of interest. 3. Protect client confidentiality. 4. Comply with relevant laws and regulations. Basic accounting software. While not necessary for understanding accounting principles, familiarity with accounting software can be helpful. Popular accounting software for beginners include 1. QuickBooks. 2. Xero. 3. Wave, free for basic features. These tools can automate many accounting tasks, but understanding the underlying accounting principles is important to maintain proper financial records and interpret the financial statements. Accounting might seem daunting at first, but with practice, these concepts will become second nature. Remember, good accounting practices are essential for making informed business decisions, securing financing, and complying with tax laws. We will tackle more complex accounting topics in future videos. We will cover topics like depreciation, revenue recognition, financial statement and ratio analysis, to name a few. This brings me to the end of this video. I hope you gained a better understanding of financial statements from watching this video. As always, please remember to leave your comments in the chat, and like and subscribe to the video. Also, let me know which topics you would like to see us cover in the future. See you in the next video.